levels once again. In fact, let's talk about all of that with our expert also joining us on the show. Chakri is the CIO and MD of TCG group, which is the strategy group. Lokapriya, good evening. Thanks a lot for joining us. The market rebound 300 points from 8,000, but then we gave up almost 200 points today. Clearly the rebound was very short-lived. Was it a dead cat bounce, or what's your near-term call on the market right now?
Hello Ajay, I think we'll remain range bound in the Nifty for the coming few sessions, mainly because until we see clarity in MAT, GST, the market is unlikely to move up markedly from current levels. On the other hand, we continue to see pockets of growth, and we still maintain our year-end calendar target of 9,500 for the Nifty.
Right, so what's the market strategy that you're adopting right now, Chakri?
We are buyers at current levels. We are identifying pockets of growth. What we are doing is staying away from deep cyclicals, telecom, E&P oil companies, and big cap IT where there are company specific problems. On the other hand, you have mid-ticket consumer discretionary companies such as Blue Star, which are easy on the pocket for the consumer. Cement has seen a pickup in demand in the month of April after a downtick in March, and indicates a certain amount of pickup either in government spending, government projects, or corporate revival, and still and largely a pro-cyclical stance.
Over the next few months, what's really going to be on your radar in terms of monitorables that you think will impact market movement?
I think we have 3 or 4 things. One is the MAT. We've all seen that an ill-timed MAT led to a $2 billion sell-off. So positive resolution by the panel is important. GST, I think if we come out with a tax rate of 23 to 25%, if it is passed, will be positive for the markets. Land bill, I think now is probably likely to happen much later, and probably in the coming session of the Parliament. I think these are the 3 or 4 monitorables for the market to stabilize and start rebounding.
Chakri, you said earlier that you have a pro-cyclical stance on the market. So at the current juncture, what are your top bets to be bought on declines? And also tell us about your big avoids.
I think the biggest avoids continue to be metals, continue to be E&P oil companies, and telecom. They have done well year to date, but don't see much further growth. And in terms of where we see growth and position is cement, such as JK Lakshmi Cement, consumer durables such as Voltas, Blue Star, and as well as export-related companies, mid-cap IT, pharma, export-related auto ancillaries where the growth is strong. U.S. companies still continue to beat expectations, so we are positioned in export-related sectors as well.
Right, Chakri, also tell us how are you witnessing global developments, especially how prepared do you think emerging markets like India are right now if the U.S. actually decide to start hiking rates in the second half of this year?
I think the good news is real interest rates in India have turned positive after a number of years. And given current RBI's policy to maintain an real interest rate differential of 1.5% to 2%, this gives RBI to cut interest rates by another 75 to 100 basis points. So this, even if they cut by 100 basis points, it should not impact flows, and we will be positioned well for an eventual U.S. interest rate hike.
You know, in terms of just how India stacks up compared to other emerging markets, what would the pecking order to your mind be like, especially when compared to, say, China?
China has done remarkably well over the past year. It's outperformed. Even currently, its PE is 12 times forward, so it's not expensive. However, its EPS growth rate has slowed to about 2 or 3%, and its ROE is about 13 to 14%, which is the lowest level in the last 3 or 4 years. But again, recent interest rate cuts in China should help in reviving corporate demand in China. I think India's earnings growth in the following year will be higher than that of China, and I think incrementally India is well positioned, and so is China.
What are corporate earnings, Chakri? When will things really on that front, you think, recover?
Two or three things have happened here, Ajay. One is revenue has fallen for the companies reported so far, anywhere between 15 to 20%. On the other hand, EPS has grown by about 10% because of lower commodity prices, which has helped in margin expansion. But net, the growth has been lower than expected, and we will be cutting our FY16 earnings estimates by about 3 or 4%. But we'll be revising up our FY17 earnings, and I think the market does not reflect the eventual uptick that will come in FY17, and we remain buyers at the current levels.
All right, Chakri, we'll leave it at that. Thanks so much for taking time out for us this evening.
All right, let's take a short break. On the other